Welcome back to World Insight, bringing you the stories of the past week. And one of the big stories was China going gold crazy, with shoppers and investors buying up everything in sight. Sparked by a slump in gold prices, buyers are hoping to profit from what could be a golden opportunity. Our reporter Ding Dai went to some gold stores in Beijing where millions of yuan were changing hands in a matter of just hours.
A hunger for gold. The recent plunge in gold prices has sparked a shopping frenzy in China. Shoppers swarm into gold shops, desperate to get their hand on a bargain.
The gold prices have come down quite a bit. It's 30 to 40 yuan cheaper per gram. I bought a bracelet for my daughter the other day, and now I'm here shopping for my sister.
At the Caishikou department store, the largest gold dealer in downtown Beijing, gold bars and accessories are selling like hotcakes, and it's a big challenge to maintain inventory.
During the May Day holiday, our sales topped 200 million yuan. That's over 30% up on last year. These days, customers even have to wait in a line to check out.
The latest rush for gold began on April the 15th, when international gold prices dropped by 15%, from nearly $1,600 per ounce to nearly $1,400 per ounce, the biggest one-day decline since the 1980s. Many believe the drop just followed a commitment by Cyprus to sell excess reserves. But while many institutional investors have been shorting gold, many individual investors see it as a golden opportunity for a great deal. Chinese shoppers just can't get enough. In the past 2 weeks, they spent over 100 billion yuan on over 300 tons of the glittering stuff. And for some of these shoppers, their lust for cut-price gold has seen them travel far and wide. They are going all the way to Hong Kong, where gold prices are lower than on the mainland. During the three-day holiday, Hong Kong retailers were overwhelmed by tens of thousands of mainlanders, and visitors to Hong Kong increased by about 15% compared to the same period last year. And as Chinese consumers stocking up on gold, some even say Chinese mothers has beaten Wall Street by forcing gold to rebound. The May holidays are usually called Golden Week, but this year, with the gold rush spread across China, they may well call it Gold Week. But while Chinese buyers' faith in the yellow metal stays strong, still remains to be seen whether their investment will pay off. For World Insight, I'm Ding Dai in Beijing.
Now, for more on gold in China, we're joined by John Ross, a senior fellow at Renmin University, also a former consultant in the gold mine industry, and also here in our studio, Cao Can, CEO of Shengya Capital. Thank you very much to you both for giving us your time. Before we talk about the gold rush, let's talk about gold prices. Gold saw a 15% drop in mid-April. Analysts are saying that the price would have fallen further if not for the frantic buying by Chinese homemakers over the May holidays. Was it all sales to individuals, or were large chunks of that, like banks, buying up cheap gold? John, let's start with you.
No, it was fundamentally gold is a lagging indicator of commodity prices. It tends to follow about 6 months behind them. And commodity prices have temporarily stabilised, so the gold price has temporarily stabilised. The individual buying of gold is rather peripheral in the gold market. It's the big institutions' activity which counts.
Tasan, let's head over to you. What's caused this price fall? We heard just there from John. Is this just a simple market correction that we're seeing here?
Well, I think that there are three major reasons. The first major reason is that Goldman Sachs, a major investment bank which have a lot of clout in the financial community, issued a warning that the gold price would collapse. And when Goldman Sachs speaks, other people listen. Now, the second reason is that there's a worry that indebted European nations like Cyprus, Greece, Italy may have to sell their gold reserves in order to raise money to pay back the debt. And the third reason is that there is this false belief that there's an economic recovery in the US and Europe, and because the economy is going strong again, there's no need to hold gold, which traditionally serves as a safe haven during a time of crisis. But I think these reasons are just temporary. I think that the recent decline in gold is a correction in a bull market. You know, gold has been in a bull market for 12 years. So gold is entitled to a correction. You know, it's naive to believe that just because the price of gold declined 20% from its peak, and then, you know, it is the death of the bull market. I think it's very premature to say that.
I want to ask you, Cao Tan, you mentioned there Greece and Cyprus, two relatively small countries in Europe that have seen much change in the last couple of years. But do they really have the capacity to bring about a shift in dynamics for the gold market worldwide?
Well, I think the shift, what would happen is that the gold will be transferred from the Western European countries to the emerging nations. The worry is that if Cyprus have to sell their gold reserves, other indebted nations would have to follow suit because they have nothing but gold. You know, they have a lot of sovereign debt, and the creditors like China, Japan would have to demand gold for payment of their IOUs. And so what is going to happen is that a lot of these gold, which are currently sitting on the vaults of the banks, of these European banks, would be shipped to the emerging nations, which is a good thing for the long-term price of the gold, because, you know, these emerging nations would gobble up these gold and probably back their currency with gold, and that would provide a long-term support for the gold price.
John, I want to ask you, do you think that gold really is a gold investment option right now, particularly being here in an emerging nation? Do you think consumers in countries like China or maybe in Brazil or in countries in Africa really have an opportunity?
No, I think the big bull market in gold's over. We saw from 2000 to 2008, and then took this little peak in 2011, the biggest commodity bull market in history. And it's over. For the last 2 years, commodity prices have been falling. The world economy is weak. And at the present time, the only thing that's supporting the gold price is very low interest rates in the United States. I think that'll put some floor under the market, because the problem with gold is it doesn't pay any interest. So I don't think there's a huge downside potential in it at the present time.
But the thing is that the interest rate in the US would stay low for as long as eyes can see. So what that means that the Federal Reserve would continue to print money, and the quantitative easing would go on for as far as eyes can see. That means the US dollar would get devalued, and all the currencies are also weak. You know, the British pound is a very weak currency, and the Japanese yen is also very weak. So, you know, because, you know, central banks around the globe are debasing their currencies at a very rapid pace, that means the current bull market in gold will continue for a long time. You know, it's very ridiculous to say that because the gold price has declined for 2 years, we have the end of the bull market. If you look at the stocks, the Dow Jones had a very good run from 1980 to 2000, but we still have the 1987, the big stock market crash.
Let me just break in over here, because John, I see you pursing your lips, shaking your head a little bit.
Yeah, no, because that's a type of old-fashioned type of monetarism, which I don't think anybody internationally takes seriously anymore. The
central banks.
John, let's hear from you first.
Could I speak? Yes.
The central banks in
John,
Asia are taking it very seriously.
John, tell me first.
Yeah. It is an old-fashioned type of monetarism which believes if you print money, you get inflation. It's not true. You have had a huge printing of money, and inflation hasn't been going on for the last 2 years.
What is the definition of inflation? Inflation is an increase in the supply of money and credit.
Let's just give a bit of time over to John. Just finish off what you were saying over there, and then we'll go back to Cao Tan.
It's not true that the printing of money necessarily causes inflation. It's the velocity of circulation can drop, and that's what's happening at the present time. The central banks are printing money, and for the last 2 years, commodity prices have been falling. Lloyd Blankfein of Goldman Sachs is quite right, but he says actually at the present time, deflation is a bigger threat
That's what Bernanke said.
than is inflation. And for that, under those circumstances, there's not going to be any big upside to the gold price. It's simple. And the theory that because the central banks have printed a lot of money, therefore there's going to be inflation, is just being refuted every day by what's happening.
Well, I think you know, John Ross just doesn't understand what inflation is. But let me tell you what the definition is. Inflation is increasing the supply of money and credit. So when central banks print money, that by definition is inflating. Now, we're not seeing the inflation in commodity prices right now. Why? Because a lot of that printed money goes into the bond market. So we are seeing a lot of inflation in bonds. The price of the U.S. Treasuries is very high. The yield is very low. We also see a lot of inflation in the stock market, in a real estate market, you know, because the mortgage rate is very low. So all these, extra liquidity is currently going into other asset markets. It's not going into commodities, but inflation is still there. Inflation, by definition, is an increase in the supply of money and credit. It's not an increase in prices. Increase in prices are the result. The cause is the central bank activity. So I think, John, you need to check the dictionary about what inflation actually is.
Let's get past this point for a minute. I'm glad we're having a good debate over here, though, because gold has become more popular as an investment option here in China, with many believing that it is immune to inflation. Now, gold consumption surged to 832 tons last year, 9% year-on-year increase. Jewelry purchases totaled just over 500 tons, a 10% increase year-on-year. John, why is gold such a popular form of investment despite low returns?
Many investors have the false belief that there's going to be inflation, and there's not going to be. Inflation is not the printing of money. Inflation is the increase in prices. At the present time, prices have been falling.
Well, the prices are not falling.
Sorry,
look at the price of the
oil.
Look at the price of the real estate market.
Okay,
look at the price of the bond market.
We are going to get to you.
Up.
Let's ask John to finish his point first.
Well, what he said is just so false. I have to jump in on it.
But John, let's finish your point first. I will give you space.
Yes, exactly. As I said, inflation is rising prices. People think that prices are going to rise, and they're not. Inflation is very low, and the printing of money is not going to make a difference. The gold price has fallen by 23% since its peak, and it's following commodity prices down.
It's ridiculous. The price of gold has been going up for 12 years, and we just have a 2-year decline, and you're saying there's no inflation?
Look,
Back in 2000, the price of gold was $300 an ounce. Today, it still hovers around $1,500 an ounce. So, in other words, the price of gold has more than quadrupled. And you are telling me there's no inflation? Can you just open your eyes to a flood of inflation that's going? Look at the price of the pork, the price of the beef, the price of milk, the price of clothing. I mean, the price of everything is going up. I mean, just do some shopping. Maybe a bottle to do all the shopping for you, so you don't know what's actually happening in the world.
I assume you interrupt all the time because you can't reply to the
argument. Because what you said is so false. I mean, I have to correct you because you're making all these mistakes.
False or not, John deserves his time to speak. John, you're one of our guests. Let's hear what else you're going to say.
At the present time, inflation is rather low on the international level, and it's tending downwards. And that is fundamentally going to continue as long as commodity prices are weak. Gold is an investment because people think that prices are going to go up, and they're not going to go up. The big institutional investors, therefore, at the present time, are quite right to get out of gold. I'm sorry, but the small individual investors are making a wrong judgment about the situation. Goldman Sachs is correct. We're in a situation where there is no strong tendency to inflation. It's not going to be a disastrous investment because as long as interest rates stay low, there won't be a very big fall in the price of gold. But it's going to be either stable or not very good return. And it's already 23% off its peak, and that's going to continue.
But we have seen Goldman Sachs becoming just the latest of the big banks to predict further declines in gold prices. Cao Tan, but what we're also seeing here is the transfer of gold from west to east where you live. Is the Chinese government also showing its strength with the buying up of gold as a backing to the yuan currency? And if so, how is this going to impact the US dollar?
Yeah, I think the central banks in China and Japan are much smarter than Goldman Sachs. Goldman Sachs is saying the price of gold is going to go down, but all the central banks know better because they're snapping up gold. They're doing a lot of bargain hunting right now, and I think what John Ross just said just shows that you can be a talking head without understanding basic economics. Because today the price of everything has been going up, and he's saying there's no inflation. He's buying into the nonsense propagated by the Federal Reserve that there's deflation. How could there be deflation when the price of everything has been going up? You look at back in 2008, the S&P has declined to 666. Today is more than doubled. I don't think the U.S. economy has recovered much, and you admitted to that. So what is driving the stock market wrong?
I do know that, John, you've been a long-time principal economic advisor to the Mayor of London, a global capital. I want to tap in, though, into your local knowledge because you've worked here and with China for many years now. Chinese investors, John, are also looking at other options besides real estate and the stock market for their investments. Could this be one reason for this big jump in gold demand that we've seen here for 2 weeks?
Yeah, it is a reason, but it's not a correct judgment. The real good investment in China at the present time is housing. The government is putting money into consumers' pockets. The best investment in China at the present time is to have a job. because real wages are going up to 8–10% a year. And therefore anything which is linked to wages is going to go up. That's why there's very rapid increase in the housing prices. So real estate, or housing real estate, is a very good investment in China, but gold is not a particularly good investment, and that's going to continue to be the case.
Well, it just shows how little John really knows about investing. He's saying that the real estate is a good investment today at this price. I mean, are you kidding me?
Well, Cao Tan, in fairness, the program is coming to an end, but we can continue outside the studio with the rest of this debate. John Ross, Cao Tan, thank you very much for making this such an interesting and exciting discussion. If you've got your own voice to add to John's and Cao Tan, you can do that. Email us your thoughts to worldinsight@cctv.com.